the conditions are in place for the markets to crash in 2025. Very much so. If we're right on inflation, if we're right on this global refinancing cycle, potentially, morphing into a global refinancing air pocket whereby we don't see a big enough acceleration or even a deceleration in the growth rate of liquidity, which, essentially is global investor balance sheet capacity.
Major asset allocation priorities and the outlook for markets, equities, bonds, fixed income, precious metals, everything in between. We'll be talking about this with Darius Dale. He is the founder and CEO of 42 Macro. Welcome back to the show, Darius. Happy New Year. Thanks for being back.
Happy New Year to you, David. Thanks for having me back. I appreciate this.
We spoke 3-4 months ago. People can check out our last interview, link down below. You made a very interesting call about how to prepare for volatility long-term. Long-term, you believe that there's a coming fourth turning, which involves a lot of geopolitical risks that we have to factor in as investors. Now, looking ahead, since you were on the show, Trump has been elected. That was possibly the biggest change. And of course, we've talked about monetary policy a little bit. Anything else that has changed for you in the last 4 months that has made you possibly reshuffle your asset allocation priorities?
Yeah, it's a great question, my friend. Again, thanks again for having me. So I'll start by saying when we were on last time, you and I unpacked our thesis regarding the fourth turning and how that is likely to contribute to structural bull markets in risk assets and gold, like stocks, gold, Bitcoin. Yes. And really what's driving that is the monetary policy response, the likely monetary policy response to what we continue to observe as fiscal dominance. We are in this fiscal dominant regime whereby debts and deficits and the overall influence of the government on the economy is wider than normal. It's much larger than normal. And in our opinion, we think the Federal Reserve, generally speaking, over the long term, is going to essentially be forced to maintain easier than what would otherwise be appropriate monetary policy for the current economic dynamics and likely economic dynamics. And so, we are structural bulls on risk assets and gold. There are times to manage risk. There are times where the Federal Reserve is unlikely to be able to, from a political standpoint, be as supportive. And in those particular pockets of monetary policy retrenchment, we will be experiencing, likely, significant leptocurtic, if you will, drawdowns in asset markets. And so there's potential for one of those outcomes here in 2025, which we can unpack. And then from a cyclical standpoint, so that's our longer term belief. Those are our core longer term beliefs. From a cyclical standpoint, one of the things we talked about last time was the resiliency of the economy. It persistently surprising consensus expectations to the upside. Recall that was a theme that we authored back in 2022. We continue to see that theme as persistent. And so no changes there. And then as it relates to our sticky inflation thing, I think we're a little bit further along. We're a little bit further along in terms of where we are in this disinflationary process. In fact, if you look at our models, we are, sort of pointing to, kind of a near-term bottoming in inflation and inflation that's likely to meander higher over the medium term. And if that's the case, then that could potentially pose some problems from asset markets from the perspective of the monetary policy response function here in the U.S. And so that monetary policy response function, of which we've titled our J wants a soft landing thing, which again, we introduced in November of 2023 as a precursor to the raging bull markets that we saw in 2024 or in the fall of 23, some winter of 23, and then throughout 2024, that we've lost a tremendous amount of conviction in that theme in recent weeks, going specifically to the December 18th Fed pivot. And so the Fed, which had a asymmetrically dovish reaction function, now only has a modestly dovish reaction function. And then as a function of that, you're probably going to see a lot, the kind of the strike price for the Fed put, if you will, that's a bit lower than it had been. And then finally, on the fundamental side, and again, we can unpack any of these in succession or however you wish to go. But the final thing we would say, since we've last connected, I believe we talked in early October of last year, we introduced our triple S's theme in November of last year, immediately following the election. And the real key takeaway from that theme is that, asset markets, given that we are in this asymmetric point in the positioning cycle, they may struggle with respect to the uncertainty regarding the size, sequence, and scope of pending, potentially dramatic fiscal and regulatory policy changes. One of those changes, in my opinion, is the likelihood that we're probably going to see tariffs and a change in border policy that could potentially create a negative supply shock in the economy, we're obviously going to get tax cuts, deregulation, accelerated energy production, which may create a positive supply shock in the economy, but we may get the bad stuff first. And so that could potentially cause problems in asset markets, alongside the fact that we are likely to see a hawkish shift in Treasury net financing policy in terms of the composition of Treasury financing. And so that could create some problems in asset markets as well. And again, this is all predicated on the starting point of us being in a very asymmetric point in the positioning cycle.
Before we continue the video, let me tell you about how important it is to protect your personal data. A massive data breach recently exposed nearly 3 billion personal records, once again highlighting the growing risks of having your private information online. It's a reminder of why protecting your data is so important. That's why I use today's sponsor, Delete Me. They help remove your personal details like your address, phone number, and more from hundreds of data broker sites. It's simple, effective, and something I trust to keep my information safe. Getting started is quick. Submit your details, and within a week, you'll get a privacy report showing exactly where your data was found and removed. Delete Me keeps working all year round to monitor and remove your data so you don't have to worry. Go to joindeleteme.com/David Lin, link down below, or scan the QR code here and use the promo code David Lin at checkout to get 20% off of all US plans. Start taking control of your privacy today. Okay, Darius, let's talk about asset allocation now. As you know, the first week of January has not been kind to equities, especially last Friday when the jobs report came out. It beat expectations, and the equities markets went down. The S&P was down like 1.5%. The NASDAQ down 1.5%. On Monday as well, not a great day. We're talking on Monday the 13th. Not the greatest day for stocks. Are you still overweight stocks for 2025, or are you maybe switching to a more defensive posture given the recent performance of stocks?
Yeah, great question, David. And so, I'll start by saying, everything we just highlighted with respect to those fundamental research themes, none of that information has any bearing on the asset allocation and portfolio construction recommendations that we help our clients use to manage risk. That those processes are completely systematic, quantitatively oriented processes, and that fundamental research just helps them build the confidence needed to actually act on the signals when the signals change. And so if you look at our current KISS allocation, KISS is short for keeping it simple and systematic. This is the 60-30-10 trend following strategy that we built to help 42 macro clients, retail investors specifically, retire on time and comfortably. That's the main goal of the program. And so when you look at where we are currently, we're currently at 52.5% cash, so significant reduction in cash relative to where we were that last time we spoke. We're 50% of our maximum exposure of 60% in stocks vis-a-vis the SPY ETF. So again, a significant reduction relative to where we were. I think we were maxed out last time we talked. We were 50% of our maximum exposure of 30% in gold vis-a-vis the IAU ETF, and they were only at 25% of our maximum exposure in Bitcoin vis-a-vis the FBTC ETF. And so, this the systematic strategy, which we're using our market regime nowcasting process to incorporate volatility targeting into the strategy, and then we use our volatility adjusted momentum signals for each of these three ETFs to incorporate dynamic position sizing in the strategy. And when you sort of the refresh of those models has caused the system to take down risk. And that's one of the core features of the system. The system is designed to take down risk, potentially heading into significant corrections and or crashes in these asset classes. And it does a great job of doing that in terms of the average annual return being about 20% with a max drawdown of only minus 11%. So you're talking about a CalMAR ratio almost 2. That's average annual return divided by the max drawdown. If you're going to run that same system without our overlays, in terms of the top-down risk management overlay or the bottom-up risk management overlay that we use to actually guide the position sizing, if you're going to just be naked long 60-30-10 stocks, gold, and Bitcoin all the time, you're going to have basically the same average annual return, but a significantly worse performance from a max drawdown and volatility perspective. In fact, the max drawdown is more than double, minus 25%, and you would have crashed 3 times over the past 6 years, just being naked long stocks, gold, and Bitcoin to those degrees, as opposed to using our systems to dial up and dial down that exposure. So, quite proud of this system. It's working really well for our clients. We have thousands of clients around the world that are implementing these systems. And I use this system to manage my entire liquid net worth as well. And so, obviously, we did quite well over the past couple of years in the raging bull market, and we expect to do quite well this year, even if we were to heading into a bear market. So that's kind of where we are.
Well, good. Congratulations on your success so far. So let's talk about the previous. Yeah, let's talk about this chart for just a minute. The four asset classes that you've highlighted, the blue, green, red, and orange bars here. Let's talk about these four things and what role or purpose each of these serve for your portfolio. In other words, is gold a risk on? Is it a hedge? Ditto Bitcoin, equities, and liquidity.
Oh yeah, absolutely. So obviously, equity risk, that's going to be your bread and butter if you're talking about building any sort of retirement account. Bread and butter, exposure. When you think about gold, gold is a much lower beta exposure, is about a 0.3 trailing 6 month beta to the S&P of 100. And so we use the gold allocation to add a little bit of diversification into the portfolio from the perspective of lowering the overall beta and introducing non-correlated asset classes into the portfolio, which helps with the drawdown and volatility characteristics while also exposing you to some of the monetary policy dynamics.
I'll stop right there. You are the first guest who is completely aligned with what I've always thought about gold, which is that it's not necessarily a tool used to hedge against big drawdowns in equities. It's not risk on. It's not, it's somewhere in between, which is that it reduces your it increases your Sharpe ratio because it reduces your volatility because it's low beta, non-correlated. The correlation between gold and stocks historically is very, very low. So yeah, anyways, I'm glad you brought that up. It's,
well, I cut my back. So my background is in institutional portfolio construction and asset allocation. And so this is, when we build systems like this, we are taking, what has been 16 years now of my career on Global Wall Street, liaisoning with, some of the world's best institutional investors on developing and designing systems like this. And, we're sort of taking that 16 years of wisdom and applying it to develop the development of this strategy here. So, a lot of what you see on the page here is just a function of, my conversations and my, learning journey throughout Global Wall Street.
Yeah. Have you noticed that it actually works in that regard? In theory, it works. You take a correlated asset with stocks and you put that in your portfolio, you're reducing your volatility. But have you actually noticed that it's increased your risk-adjusted return?
Oh, of course. Absolutely. 100%. So again, the Sharpe ratio of the strategy is 0.9 relative to the Sharpe ratio, if you're, say, just running regular 60-40, 0.6. The Kalmar ratio, which is, again, the average annual return divided by the max drawdown, that's our strategy. The KISS strategy is 1.9. So if that's almost double what a good Kalmar ratio would be. And if you wanted to compare that to 60-40, it would only be 0.4. The Kalmar ratio of 60-40 is only 0.4. It only has an average annual return of about 9% with a max drawdown of a minus 22%. So, this system works. Part of the reason the system works is because, again, there's three core elements of the system. One, this factor selection. We're going to beat 60-40 by, removing our exposure to the bond market, but replacing it with instruments that may have similar characteristics in risk-off scenarios like gold, or may have similar characteristics in a Goldilocks type scenario like Bitcoin. So that's kind of step one. Step two is we incorporate volatility targeting, which is one of the hallmarks of institutional finance into our system. And then number three, we incorporate dynamic position sizing into the system as well. And so again, these are all quantitatively oriented systems. It's a completely systematic system. The system does not care about what I think about growth, doesn't care about what I think about inflation or liquidity or corporate profits or positioning. All it cares about are the volatility targeting and dynamic position sizing models that are contributing to the actual allocations that our clients express or feel in their portfolios.
And so what about Bitcoin? There has been a very close correlation with the NASDAQ. Are you using Bitcoin as leverage play on liquidity and equities, or is it its own asset class that you're using independently?
Yeah, no, it's a little bit of both, right? So again, the trailing 6 month beta of the S&P 500 is 2, but again, there are times where the correlation is not particularly robust. And so you can also, anytime you add an uncorrelated asset to a portfolio, you tend to wind up with higher risk adjusted returns. It's kind of a dirty little secret of institutional finance. And so Bitcoin, even though, a lot of folks sort of think about it from the perspective of, this is just a levered play on NASDAQ type beta, which in many cases it is. I certainly am one of those people who authored that kind of line of thinking back in the summer of 2020. In many cases, it actually is, but in not all cases. And more importantly, the most important point is when you add it to a portfolio and you actually trade it properly, within the context of that portfolio, you improve the risk-adjusted returns of that portfolio, and that's what we want as investors, right? It'd be great if we can all do 20% average annual returns per year, and you can if you just want to be naked long these asset classes. That's easy. Just be naked long those asset classes in the 60-30-10 allocation. However, if you want to have those returns while also sleeping comfortably at night and not, having a risk of losing 20 to 25% of your overall net worth every 2 to 3 years, which is the historical frequency of this backtest implies, then you need to actually have sophisticated risk management systems that allow you to manage risk. And our sophisticated risk management systems, are outstanding at helping investors manage risk.
Yeah.
If you look at our discretionary risk management overlay backtest, which combines those top-down and bottom-up risk management overlays, and sends out signals for our institutional clients across 70 different factors. If you look at it specifically for stocks, gold, and Bitcoin, 98% of the cumulative performance of the S&P 500 has come when our risk management overlays have basically said you need to be long stocks. Now, and the reason this is important is because it doesn't have you long stocks when you don't need to be long stocks. So ultimately, it increases your risk-adjusted returns because you're not long during the drawdowns. You're not long during the significant corrections. Mm-hmm. That upside capture ratio is 148% in gold. So you would actually make more money trading using our signals to trade gold than you would if you were just naked long gold, buy and hold gold since January 1998. That same dynamic is 113, or same statistic is 113% for Bitcoin.
But the concept of using an asset like gold or anything else that's non-correlated or very low correlation to the equities market as a way to reduce volatility and boost the Sharpe ratio, why would you not just use cash, for example? It's also not correlated. It's defensive. And right now you're getting a pretty good yield.
Yeah, 100%. We do use cash. And so whenever those positions, whenever we see a reduction in position, whenever the trend following system takes our any one of those positions, SPY, IAU, and FBTC, whenever they're not at 100% of their maximum allocation, which is 60, 30, and 10% respectively, then the residual goes into cash. And so cash right now, as I mentioned when we started, it is at 52.5%. We use USFR, which are floating rate.
But I mean, why not just replace it with cash altogether? I think is my question.
You mean so instead of having 60, 30,
instead of having gold, just use cash for that purpose?
Oh, yeah. Well, again, don't forget we have a fundamental view that gold is in the secular bull market, so we want to take advantage of that as investors.
I see. Okay.
Yeah, cash. The return, the average annual return on cash is going to be limited to whatever the cash rate is. Whereas we just came out a year where gold was up almost 27%.
I know
I'd rather be up 27% than 4.5%.
I know the quantitative aspect of this model doesn't depend on your views on inflation and whatnot, but I would like to get your views on the economy because you have excellent views. Let's start by talking about the drivers that you think are going to be working in favor of your equities overweight this year.
Well, so again, we're not overweight equities. We are at 50% of our maximum exposure of 60% in equities. So we were almost cut in half. I would say it's a significant change relative to where we were the last time we spoke. Again, we are at 52.5% cash. We are overweight cash right now. That's the key takeaway from the context of this model. And so I think it's important to talk about some of the fundamental drivers of why our quantitative risk management signals have moved us from being max long, max invested across those three asset classes to essentially being half invested across those three asset classes and only 25% invested specifically in Bitcoin currently. And so that's a significant change from where we've been in recent, and really over the past 2 years almost. And so, that's a very important call out in and of itself. And so we can talk about the fundamental, what I think is happening in the economy from a fundamental perspective that is potentially contributing to those leading quantitative risk management signals driving the KISS allocations.
So if you could just summarize your stance once more, are you risk on right now, or are you risk off, or because you're balanced all over the place, which is, are you defensive right now? Are you, what's your sentiment?
Obviously we're risk off right now for 52.5% cash. Yeah. Risk on would be 100% fully invested in those asset classes at 60% stocks, 30% gold, 10% Bitcoin.
So are you?
We're currently only 30% stocks, 15% gold, and 2.5% Bitcoin. So that's a significant departure from the maximum exposure we can have in each of those asset classes. So that is risk off.
Are you expecting a correction anytime soon?
I think we can. I think this market can crash in 2025, 100%, and I can give you all the reasons why.
Yeah.
Now, whether I think the market can crash in 2025 is no bearing on that systematic strategy. The systematic strategy is going to do what it does based on those risk management overlays.
Okay.
And so my job is as an investor, as the person sort of communicating to our clients, is help them understand the full distribution of probable outcomes such that when the system makes them raise cash in their portfolio, they understand why and how long this is likely to last and how deep the corrections might be in those various asset classes. Or if the system tells them to get fully invested with 0% cash, which is where we were for most of the past 2 years, then you'll understand why there's a lot of right tail risk in asset markets. And so I think in the context of the 52.5% cash, it probably behooves us today to talk about some of the left tail risk that we see developing in asset markets.
Okay. So that is a departure from your stance from a couple months ago.
From the last
Okay.
time we talked.
Risk off right now. Walk us through why, given that, the Trump trade hasn't technically happened yet. Well, maybe it has. Maybe it's already been priced in. Trump hasn't taken office yet. But I remember when Trump won the election first week of November, euphoric equity markets. But walk us through why you're a little bit more cautious.
Yeah, 100%. So I'll start with our grid model projections. So if you look at where our economic projections are calling for with respect to the U.S. economy, we have the economy. Let's take a step back. We've been, so we authored our resilient U.S. economy theme back in the September of 2022 and maintained the theme the entire time since. And we still see the economy as resilient, as unlikely to slide into a recession over a medium-term time horizon. However, what is new about the current setup relative to where we were is that growth is actually slowing now. And if you look at our projections, it's probably going to get to a below trend level by the time we get into the second quarter. So this is new. And more importantly, the delta between our estimates and consensus estimates has narrowed to a significant degree. And so we are no longer expecting upside surprises to the same degree that we were over the medium term. So that's kind of step one on the growth side. On the inflation side, we have our models suggesting that the inflation process is actually bottoming or bottomed in Q4 of last year and is likely to meander higher over the medium term with the significant acceleration kind of starting in the second half or in the middle of 2025. And obviously, if those projections are correct, then we're going to have a very different conversation about the outlook for U.S. monetary policy and the likelihood that the Fed is going to be able to cut rates at all in 2025. And so that's obviously unsupportive of asset markets. And then you think what could potentially be driving an upside surprise in inflation. You think the one thing I would say is that when you go back and you study how the business cycle actually works, and we did a big deep dive empirical study on the U.S. business cycle to figure out how it works, studying hundreds of economic indicators from each of the 12 post-war U.S. recessions. What this chart on the left identifies is how each of these various cycles behaves late in the business cycle into and through a recession. And so what you typically see is that policy first gets restrictive, let's call it 15, 18 months ahead of a recession. You got corporate profits. They tend to break down right around a year ahead of a recession. Liquidity breaks down around 3/4 ahead of a recession. Growth in stocks break down simultaneously. Let's call it 6 months ahead of a recession. Employment breaks down right when the recession starts. Credit breaks down kind of right by basically a quarter after recession. And then finally, inflation, which is the most lagging indicator of the business cycle, breaks down durably below trend 12 to 15 months after recession. You can see it a little bit easier in this chart here where we show headline and core CPI relative to growth. And so this, again, each of these plots and these charts represents the 12 post-war U.S. business cycles sort of stacked on top of each other to give you an indication of how these cycles have historically evolved. And so if you believe that if you believe in the persistence of our resilient U.S. economy theme such that we are unlikely to have a recession over a medium-term time horizon, then you must also believe that it's very unlikely that we have a durable breakdown to and below trend in inflation. And so if that is true, then it's very likely that once we hit the bottom of the inflation sine curve and the base effects start to recede, you're probably going to have a significantly higher, or not significantly higher, but modestly higher levels of inflation over the next 12-month time horizon, at least according to our model. And we're actually starting to see some evidence of that. If you look at core PPI, which has been a good leading indicator for this particular cycle, that started breaking down basically about a year and a half almost ahead of core CPI and the core PC deflator, which we know kind of been restrained. The improvement of those time series have been restrained by the lack of improvement in housing in housing inflation. But this core PPI metric bottomed in December of 2023 and has been trending higher over the past year or so. And if you can if you squint closely enough, the blue line and the red line, the red line and the black line in this chart, which are core CPI and the core PCE deflator, they're looking like they kind of want to bottom at this, kind of structurally elevated level for now. Now, again, this may just be a transitory bounce in inflation, for the first part of 2025 before we kind of resume a longer term downtrend back to a more kind of quote unquote normal level of inflation. But to me, a transitory bounce in inflation, when you go back and you look at those projections, when consensus is essentially projecting inflation to keep going lower over the medium term, that's a problem, especially in the context of a Federal Reserve that we may have to price out even more rate cuts from the 2025 and 2026 forward rate curve.
I've heard the view that if the Fed doesn't cut rates, which is what you're suggesting, that actually is an indicative of a stronger economic backdrop. Because if they were to cut rates, it's because something bad's happening. Keep in mind, correct, the inflation rate is still not close to their 2% target, so they have to deal with that. The jobs number that we referenced early in the interview last Friday came out very strong. That is reducing the chance of a rate cut. So I understand what you're saying, but on the other hand, the perspective here is that if they're not cutting rates, it means expansion of margins, expansion of growth. Good for risk on, no?
Yeah, no. Look, that is good for risk on, but again, you have to start with the starting point, right? Like if that stuff's already been positioned for and expected by investors, then it may not be, then it may not be the bullish catalyst that we're expecting. Mm-hmm. And in our opinion, it's already been overwhelmingly positioned for.
I see.
Like if you go and you study our positioning model, which we look at, I want to say about 15 different indicators, 15 different indicators that have long-term time series that allow us to sort of study those time series relative to how they've performed at major bull market peaks or major bear market troughs. And, the indicators that correspond to the medium to long-term time horizon, like the AI stock allocation survey, the AI bond allocation survey, the AI cash allocation survey, realized volatility as a proxy for systematic fund exposure, implied vol correlations as a proxy for market neutral hedge fund exposure. And then you look at the valuation of the market and credit spreads. Most of those indicators are at or near or breaching levels. Most of them are breaching levels that they've historically breached or record that are consistent with major bull market peaks. And the ones that aren't breaching levels are pretty close. So that tells you that the median investor, the average investor out there is already positioned for good news, for the resiliency of the economy to persist and for liquidity to rise over the medium term. And essentially what we're saying is, based on some of the dynamics that we're observing in our fundamental research process, specifically as it relates to the backup, the hawkish repricing of the Treasury curve, and the strength in the U.S. dollar, these are things that may actually cause that positioning to unwind. Right? If you look at this chart here, where we show the dollar, the real effective exchange rate relative to the growth rate of our global liquidity proxy, or where we show currency volatility relative to the growth rate of our global liquidity proxy, dollar and currency vol are moving in the wrong direction relative to global liquidity. They're weighing on global liquidity right now, in so much that the increase in interest rates is weighing on global liquidity, and the modest increase that we've seen in bond market volatility. And so if these hawkish dynamics persist, we're going to see a further decline in global liquidity. And if we had a further decline in global liquidity, you might actually start to see a lot of that asymmetrically bullish positioning start to unwind. I mean, this is how market crashes start, is when everyone's on one side of the boat and the fundamental drivers of all that positioning start to unwind. Everyone is long, a crap ton of Bitcoin and a crap ton of stocks, thinking that liquidity is going to, go through the roof in 2025. Everyone's long all that stuff, thinking that the economy is going to, continue to surprise to the upside. And if those two things wind up not being true, then you got to start to unwind some of that positioning. So that's my big fear as an investor here heading into I don't fear that, because again, our systematic systems told our clients to take down risk. And so I'm quite proud of the systems, because obviously we're seeing some consternation and volatility in asset markets, and that volatility may persist to the extent that, we are right on our medium-term outlook for growth, potentially not surprising to the upside to the same degree, and inflation surprising to the upside to an accelerating degree.
Are you expecting other central banks around the world to be equally hawkish then? Barring Bank of Japan, yeah.
Yeah. So when you look at our Bank of Japan, obviously is continuing to normalize monetary policy. When you look at our forecast for the Bank of Japan's inflation rates, it's very likely that we continue to see, if you look at our projections for Japanese inflation, we have it essentially remaining above trend throughout our entire next 12-month forecast horizon. So they're probably going to remain on the hawkish side of the central bank ledger. Now, offsetting that to some degree is the fact that we're probably going to see the ECB continue to push through dovish monetary policy. They seem to be kind of looking through what is, in our opinion, a more somewhat of an obvious backing up of inflation pressure over the past few months. And part of the reason for that is that growth, they don't have the growth dynamics in their economy to support, anything other to support concluding that this is anything other than maybe just a transitory backup in inflation. It's a little bit different in the US where we're talking about growth, still being above trend at the current juncture. Growth in Europe is below trend at the current juncture. And, at least if you look at our forecast, we have a next 12-month forecast horizon. We don't see European growth getting above trend again, at least at any point in time in that projection period. So it's our view that the ECB will continue to maintain its dovish posture over the medium term. And then obviously the Chinese, the People's Bank of China, they've already outlined what is likely to be dovish policy based on the rhetorical policy pivot we saw last fall, and the fact that we're probably going to see, the PBOC have to incrementally get more dovish in the form of currency debasement to the extent that we actually have tariffs start to be implemented. And in our opinion, we think there's no certainty when we're talking about the future here, but I think one of the more certain things we can assume in 2025 is the fact that we're probably going to have tariffs be introduced as a revenue offset to extending and expanding the Trump tax cuts.
Okay, I want to come back to tariffs in just a minute. You referenced inflation several times, and inflation ticking to the upside is a possible risk. So here's a CPI from the BLS. Which components of the CPI do you think are at most risk of either remaining sticky and or rising from current levels?
Yeah, so I mean, look, it's going to be we obviously have a big backup in energy right now, and so that the food and energy component of that is very likely to accelerate. And then you think about some of the dynamics from a unit labor cost inflation perspective. So right now we have the employment cost index slowed basically about 300 basis points to essentially 3% over the past couple of years. If we close the border and stop allowing millions of migrant labor into our country, we're no longer going to have a disinflationary impulse upon wages. And we're probably going to back up because of the structural downshift in labor supply that we've observed in our labor market. We're probably going to have a backup acceleration in wage growth over the next several quarters from this, kind of trend type level of 3%. And if that occurs without a commensurate acceleration in productivity growth, you're going to have an acceleration in unit labor cost inflation. And the only way for corporations to prevent their margins from contracting in that scenario is by increasing prices. So it may start with food and energy, in terms of the backing up of inflation, but it'll quickly spread to the more sort of core, super core type elements of inflation if, in fact, we do see an acceleration in wages and acceleration in unit labor cost inflation, which, in my opinion, are high probability scenarios. I mean, unit labor cost inflation, David, is currently tracking at minus 0.1% on a 6-month annualized basis.
Yes.
What is the probability that it stays that low over the next 6 months, over the next 12 months? Very low, right? This economy that tends to have somewhere between 1.5% to 3% unit labor cost inflation. So just going back to kind of a normal level of unit labor cost inflation without an acceleration in productivity growth, you're going to have pressure on corporations to push through a second round of price hikes. And they push through a second round of price hikes. Everything that we've been talking about in inflation, in terms of how the inflation process actually works, will start to come true.
Do you think that Trump's tax cuts would offset the need for price hikes from unit labor cost increases?
Yeah, so great question. To me, I think it's about the sequence. So in our opinion, when you go and you study the commentary from various congressional Republicans, like Mike Lawler in New York or Mike Flood in Nebraska, some of the guys who offer some commentary around this reconciliation process in the most recent week, it's pretty clear that there's going to be a long, messy fight about who gets what from the perspective of tax cuts, right? The SALT deduction is going to be a significant topic. Obviously, they have to find, hundreds of billions, if not hundreds of billions, upwards of $1 trillion of budget cuts from expenditure cuts to offset some of the expansion of the Trump tax cuts, extension and expansion of some of the Trump tax cuts. So to me, this process is the process of getting tax cuts legislated alongside the tariffs, et cetera, will probably take longer. And in our view, we think the highest probability scenario is that they split up the President Trump's agenda into 2 separate reconciliation bills, with the first being focused on securing the border and energy to give him quick wins early in his presidency that he can market to the American public, and then to have use the long, messy process that is making legislation in D.C. to figure out the exact contour of the extension and expansion of Trump tax cuts and what needs to be done to offset that from a expenditure reduction and revenue raising standpoint via tariffs. So to me, that's going to be a messy process that takes a while. And if it takes a while, then we could be talking about a lot of these negative dynamics, specifically accelerating inflation, a reduction in global liquidity, hitting the tape before we actually get the good stuff. And that, to me, the sequence matters more than anything.
Well, we know that the Fed looks at core PCE, so stripping out food and energy. But are you making the assumption that if food and energy go up, that will feed into the other components of the CPI, as food and energy are, base inputs for consumers and businesses alike?
No, not at all. No,
No.
to me, they're separate processes. I mean,
Okay.
they're obviously all correlated,
I
but
see.
no, no, not at all. I think you can. It's pretty clear that we're probably going to have an acceleration in food and energy prices. I mean, just pull up the charts, right? But in terms of the actual super core type levels of inflation, like sort of just the everyday basic inflation, your haircut, sort of the bus fares, the regular stuff. That stuff will come if we saw an acceleration in unit labor cost inflation that is not offset by productivity growth. Now, productivity growth is already tracking at a slightly above trend level of the roughly 2.5% currently. So we know unit labor cost inflation is going to go up by 100 to 300 basis points in the coming quarters. Are
We
we
have
going to see 100 to 300 basis point acceleration in productivity growth from the already above trend level? Probably not. So we're going to have pressure on corporations
Yeah.
here in this country to push through second round inflationary impulses into the economy. And that's how you can get a broad base reacceleration of inflation in 2025 that right now consensus is not projecting. And obviously the Fed's not projecting either. So that could create some problems in asset markets from the perspective of a further hawkish repricing of the treasury curve.
Well, the Fed is cautious to cut rates. So, I mean, do you think they're not projecting inflation to stay higher? Maybe they're anticipating it. What do you
Yeah,
think?
well, markets are still pricing in 1.5 rate cuts for 2025. So,
Mm,
and a full rate cut in 2026. So that needs to come out.
I
So
see.
that's an issue.
Okay.
And then secondarily, if that comes out, you think about where we could be in bond market terms and how that could potentially increase, inflate the dollar. Because again, the spread between
Hmm.
U.S. rates and the rest of the world's rates is likely to widen essentially in 2025 if the economy remains somewhat resilient, albeit slowing. And the Fed is kind of forced by inflation to do even less than what's currently priced in, which is a lot less than what had been priced in, let's call it 3 or 4 months ago.
The M2 money supply is something we haven't talked about a lot yet. It's increasing if on an annual percent change basis, up 3.7% from the previous year. How much of this increase from zero, basically, with just last year, is contributing to your higher inflation outlook?
Well, it's moving in the right direction for expecting accelerating inflation. I would argue it's probably not at levels that are going to have a significant impact.
Sure.
But again, it is the credit cycle is loosening and easing, and that is a secondary sort of influence on inflation. I mean, so there's sort of three things, right? You have accelerating credit growth, you have rising energy prices, which may create a faster rates of food and energy inflation, and then you have potential second round inflationary impacts from a tighter labor market, faster wage growth, faster unit labor cost inflation that may not be offset by an acceleration in productivity growth. Now, productivity is a very important feature in the system. If we did get an acceleration in productivity growth that offset that unit labor cost inflation, then you won't have corporations feeling a strong urge or need to pass through price increases in 2025. But again, again betting on a significant acceleration in productivity growth from here, which is already an above trend level, to me, that seems that's wishful thinking, in my
Are
opinion.
you so going back to your global liquidity outlook? Are you looking at this chart and making forecasts based on money supply as well? I ask this because you mentioned that the Fed being hawkish, other central banks being hawkish, could be detrimental for global liquidity. What if they're hawkish with interest rates, but they're a little more dovish with the expansion of the money supply and ultimately their balance sheet? Could that be a possible scenario?
Yeah, of course. Absolutely. I mean, anything is possible. To me, I'm more focused on what I think is the highest probability
It's not
outcomes.
likely that they're going to expand the money supply and increase their balance sheet this year.
No, no. If anything, they may be
Okay.
forced to contribute to a contraction in money supply. Now, again, I don't think money supply. I don't think the Fed has that much influence on money supply to begin with.
Okay.
This we know. 70% of private non-financial sector credit in the U.S. economy is not on a bank balance sheet, so it's not going to have much of an influence. The Fed's not going to have much of an influence on that. What has an influence on that is capital markets. And speaking of capital markets, David, one of the things we haven't talked about this year is this massive acceleration we see coming down the pike in global refinancing demand. If you look at the lagged growth rate, so one of the things we study here at 42 Macro is we try to understand the liquidity cycle through the lens of what's happened in the past and what needs to happen in the future from a liquidity perspective to either create good conditions in asset markets or bad conditions in asset markets. And what we see, heading down the pike over the next few quarters is one of the sharpest accelerations on record in the lagged growth rate of total non-financial sector debt. So what that ultimately means is, there's a huge refinancing cycle coming down the pike in 2025. And so if we see anything that causes liquidity to go down, i.e. more dollar strength, which seems very likely in the context of tariffs and a Federal Reserve that's less hawkish than or less dovish than what's currently priced in. And if you saw further hawkish repricing of the Treasury curve, which would be perpetuated by a potential shift in net financing policy by Scott Bessent, the new Treasury Secretary, who's been hypercritical of Janet Yellen's decision to concentrate bill funding in the bill market. If he shifts it back to coupons at the same time, we're talking about dollar strength and a more less dovish than expected Fed. You're not going to have the kind of expansion of the global investor balance sheet vis-a-vis global expansion and acceleration of growth rate of global liquidity to capitalize all that refinancing. And if we can't capitalize all that refinancing, we may have it. It's very likely we have a crash in asset markets because that's typically when crashes occur. Crashes occur when there's a significant divergence in global refinancing need and a significant divergence between that and global liquidity, and that's a reasonably high risk for 2025.
At what point? I mean, do you look at levels for markets to make evaluations as to whether or not to be long or short? I mean, at what point after this supposed crash do you look at this and say, well, it's time to reevaluate, let's reallocate assets, and let's back up the truck here?
Yeah, no point in time does anything that you and I are talking about on the fundamental side has any bearing on what we are doing from an asset allocation and portfolio construction perspective. If markets crash, and obviously our systematic process has proven itself to be quite good in helping investors get to the sideline, early in or right before significant drawdowns in asset markets. If KISS does its job and helps our clients manage risk, then at some point we're going to have a boatload of cash, as we currently do, and we'll be able to buy the dip with that as the system start to go risk on again. And so if that, I'm expecting that outcome to occur at some point in 2025. Now, whether that going back to getting fully invested process occurs after a crash or just after somewhat of a meaningful correction, that's to be determined, right? I'm certainly not smart enough to tell the stock market or the Bitcoin crypto market exactly how much it has to go down in any correction. I think anybody operating with that level of hubris is probably not going to be a very good investor. So I try to avoid those kind of very highly specific forecasts. But what I will say is that the conditions are in place for the markets to crash in 2025. Very much so. If we're right on inflation, if we're right on this global refinancing cycle, potentially, morphing into a global refinancing air pocket whereby we don't see a big enough acceleration or even a deceleration in the growth rate of liquidity, which, essentially is global investor balance sheet capacity. If we don't see that acceleration of liquidity to offset the obviously coming, refinancing need, then we could see, investors sell assets to raise the ex-ante returns on these assets. And if they do it in mass from this asymmetric point in the positioning cycle, markets will crash in 2025.
Just on the dollar, you mentioned that tariffs are probably bullish for the dollar. A lot of people might agree with you, but keep in mind Trump and Vance both have said on the campaign trail before the election that they want a weaker dollar to support American exports. So what are they going to do to either continue with what they promised on the campaign trail, or are they going to give that up altogether and just accept the fact that tariffs are bullish for the dollar?
So they don't have a choice, right? They're not in control of U.S. monetary policy and the divergence between U.S. monetary policy and the rest of the world's monetary policy. So they're not in control of that, and that's a key driver of the dollar right now. And they're not in control of how the rest of the world's economies respond to tariffs. The academic textbooks will tell you somewhere between 30 to 50% of a tariff is offset in the currency market. I would argue in this particular scenario, based on what we saw in the most recent Trump trade war in 2018 and 2019, it's going to be more than 30 or 50%. China's not going to sit there and idly by and just allow itself to get tariffed to oblivion. They're going to devalue the yuan in response to these tariffs. In fact, if you look at 2020, 2018, 2019, the yuan was devalued by 13%. And the reason this is really important for asset markets and for investors is not just because the yuan is being devalued. When the yuan gets devalued, the world's major economies have these sympathy devaluations with their own currencies. They're not going to sit there and just let China siphon degrees of competitiveness from them. And so, going back to that 2018-19, Sino-U.S. trade war, we actually saw a 13% sympathy devaluation of major currencies like the euro, Japanese yen, British pound, Swiss franc, et cetera, versus the dollar, on top of what we saw with respect to the yuan. And so if that's the case, you're talking about a much stronger U.S. dollar at some point, likely in the second half of 2025, that could potentially be supported by a Federal Reserve that's less hawkish. And again, everything we're talking about is moving in the wrong direction from the perspective of global liquidity.
Yeah.
Right, higher interest rates probably contributing to more bond market volatility, a higher U.S. dollar definitely contributing to more currency market volatility. All four of those things equals liquidity down. And if liquidity goes down at all in 2025, markets will crash because there is a significant global refinancing need, one of the greatest global refinancing needs we've ever seen. I'll throw out some statistics. If you look at the gross issuance of the U.S. Balance sheet over the next 12 months, in fact, it's about somewhere around $11.5 trillion when you add up the marketable debt, treasury debt that's maturing over the next 12 months, the annualized fiscal year-to-date budget deficit, and the annualized rate of divestment of the treasury portfolio. You're talking about a cumulative right around $11.5 trillion of gross treasury borrowing that's going to hit the tape this year. And again, that could be hitting the tape at the same time. Scott Bessent, the new Treasury Secretary, whom I've known for a long period of time, he's a longtime client. The new Treasury Secretary could actually be moving net financing policy away from the bill market and back into the coupon market. I mean, again, you can just see a scenario where we get all the bad stuff first, when it comes to securing the border, potentially creating an acceleration in unit labor cost inflation, potentially having a hawkish net financing shift, potentially having a Federal Reserve that is even incrementally marginally hawkish relative to where they have been and where they were in recent months. All this stuff is moving in the wrong direction from liquidity. And again, we need a significant acceleration in liquidity this year, David, just to have asset markets do okay. I would argue we're probably not going to get a significant acceleration in liquidity, and everything we've been talking about for the past 20, 30 minutes suggests that we could actually see a significant deceleration in liquidity. And if we get a significant deceleration in liquidity this year, at the same time, we have a significant acceleration in global refinancing demand, the markets will crash in 2025. Now, that dip's going to be bought.
Yeah.
We're still in an AI super cycle. We know we got tax cuts and deregulation coming on the other side of it. So in my opinion, I think investors will buy that dip. But again, they can't buy it now because they're all on the bullish side of the boat. They need to create balance sheet capacity and raise the ex-ante returns of all these assets before you get real legitimate dip buying in. And that could be as big as a 20% correction in the stock market.
As big as a 20% correction in the stock markets. Okay. We'll make a note of that. My final question is whether or not you think that inflation, given your outlook on inflation, do you think that inflation will erode your cash balance? You have a significant cash balance relative to the rest of your portfolio, like you mentioned. Are you concerned about losing value through inflation? And if so, how are you hedging against that?
Yeah, I mean, KISS only has a cash balance. It doesn't stay invested in cash. When those quantitative systems say, increase your exposure to SPY, increase your exposure to IAU, or increase your exposure to FBTC, those three ETFs, then the cash position will shrink. And that reduction in exposure is going to be a function of our top-down risk management overlay, contributing to a risk-on market regime, or a bottom-up risk management overlay to signaling that those assets themselves are bullish from the perspective of the individual volatility, just a momentum signal. So, yes, of course, as investors, we should always be presently concerned about inflation and obviously, cash, which does currently, if you look at it, we use USFR, which are floating rate treasuries. They're yielding about 4.8% now. So, we're still going to have a positive real return on that cash in 2025 if our inflation forecasts are accurate. So I'm not that concerned about it. But what I'm most concerned about as an investor is a significant drawdown in my portfolio because I'm failing to appropriately manage risk in a potential year where investors may be forced to manage a tremendous amount of risk.
What do you do to hedge against inflation? Usually, do you have a preferred asset or a strategy in mind? Long term.
KISS, trend following. Trend following has been proven to be the most effective system to risk manage both inflationary periods and deflationary periods.
So you don't rely on a few assets you hold long term to just protect you against CPI.
No, 100% of my liquid net worth is following that KISS system, and that KISS system, which is a trend following system in nature, is more effective at risk managing at trading through an inflationary period or even a deflationary period than just being naked long those assets. What you find, and again, this goes back to my days on institutional finance. You can be naked long an asset and generate the raw return of the asset. However, if you're naked long the asset, you also have to wear the volatility and drawdown of the asset. What our KISS system does and what our Dr. Mo system does, which is a more sophisticated, expansive system like KISS, but for institutional investors, what those systems do is make sure that you're long during when you stare at a chart. There's times in the chart where the chart is moving up in a low volatility state, and there are times in the chart where the chart is moving down in a high volatility state. We don't want to be long during those periods where the charts are moving down in a high volatility state. So that's what KISS and Dr. Mo do. They raise cash. They get you out of the assets when we're heading into one of those drawdowns and high volatility drawdowns. And when you start to break out of those high volatility drawdowns back into a low volatility, acceleration or low volatility appreciation of those assets, that's when KISS will get you back long so you can participate. Again, it's all about being there when, emphasis on when you're supposed to be there.
Excellent. Well, where can we learn more from this KISS system and follow your work?
Yeah, I appreciate you, David, man. Always a pleasure to hop on and talk institutional finance with you, man. So definitely come check us out, 42macro.com. There's a tremendous amount of information there. We also have a tremendous amount of educational resources for investors who want to get up to speed on some of these, some of these macro cycles and how to manage risk effectively in their portfolios. Check out our macro class. That's a really awesome thing that we built for investors. For every investor in the world can come check it out. It's complimentary.
All right, we'll put the link down below, so make sure to check out 42 Macro there. Darius, welcome back to the show. Good to see you. We'll have you on again soon. Plenty more to discuss, I'm sure.
Appreciate you, David. Thanks again for having me.
Thank you for watching. Don't forget to like and subscribe.